Good morning, everyone. Oh my goodness, here we are
There,
back
again, 2 years later.
2 years later, and I want to tell you that I might be coughing a little bit, but that's okay. What I wanted to do is explain to everybody what the baby boomer investing show is about. I don't think we've ever really done that at the beginning of every show.
We
This
should.
is
Yeah.
Yeah, we should, but I don't think we did have in the past, Ron. So let's talk about that a minute.
Okay.
What we have done in the baby boomer investing show is my brother and I had talked about it over Christmas when I was out at his place. That was 3 years ago. And we started talking about how he has this passion about developing a baby boomer show or trying to help baby boomers. So I said, well, why don't you come on? Let me do a show for you. So we started doing it together. And I'm the novice. I don't know anything about finances. As a matter of fact, if I have to balance my checking account, I cringe. I don't really want to have to do that. So Ron is the expert, and I have learned so much over the last 3 years that now I think I'm pretty much one that can also help the baby boomers. So what we've done is over the last 3 years, we've now restructured the 4 years. What we've done is we've restructured, and the baby boomer show is now being sponsored by the Golden Life Community, which happens to be a company that I co-founded. And this is an organization that is empowering women, mature women, to live their best life. So we are really asking the women that are here to really step up and comment and let us know how you're feeling, because you are just like me. So without further ado, Ron's going to be talking about, then we're going to go into his presentation on what it's all about today. And it's really is a good show. Good show. Okay, go ahead, Ron.
Thanks, Kath. So just on that theme, we took 2 years off. So we did 2 years of shows and decided to sort of, well, I'm going to say, Kath, you've been not so well.
I've been
So
very
you,
unwell, very still
yeah,
am.
so you've really rallied. And we were talking the other day about, the serious threats to the economy right now, and then decided to do this. Not sure we're going to do another one. This might be, well, we'll see. We'll see how it goes.
See how I
Um,
am. Yeah.
yeah. So on the next slide, we started talking about an article I wrote, Kath.
Okay. Okay.
So next slide.
Okay. Sorry.
There you go. So I wrote an article that's published January 2nd. And you can, if you Google the title of the article, Our Precarious 2024 Economy, you'll find it. And in there, I go into the reasons that we should be worrying. What prompted me to write that was I'm reading, like you all are, that 2024 is going to be marvelous. In the upper right corner of this slide, I call that gaslighting. So we're routinely being told that everything's going to be fine. 2023 was marvelous, but I'm not so sure about 2024. So in the article, I talk about more than 20 reasons to be concerned. The left on the green side, those are in the article. On the right hand side, there are other reasons to be concerned that I don't discuss in the article, but they are certainly valid. At the bottom of the slide, Kath, I want to just tell people that at the end of this presentation, I will be not just warning you, but I'll be giving you some suggestions on how to position your portfolio. And like all of our shows, this is mostly for baby boomers. For you young folks, you'll probably recover from what might happen and in the stock market. But the baby boomers are in what's called the risk zone. And one of my other articles went viral. So I wrote an article called Revenge of the Baby Boomers. 70,000 people read it, got close to 1,000 comments. So it's this really important topic. And on the next slide, I just want to give sort of a review of what we did for the first 2 years. So we had 35 episodes of the show. I wrote a book, and most of the episodes were about how to live your life, the very basics of investing. Kathy, you might want to show them the website for the Baby Boomer Show.
Okay. Will do.
So it's babyboomerinvesting.show. It's on YouTube, and you can go read these. My book is almost free on a Kindle. But the theme throughout, and it's going to be the theme for this show, is the baby boomers are in jeopardy. And what I'm warning you against might not happen. I certainly hope it doesn't. But if it does, you're going to be glad that you protected yourself. So the downside is missed opportunities. If the stock market keeps going up, you're going to miss the opportunity. If it doesn't, you're going to be glad that you protected yourself. So on the next slide, I'll tell you what our agenda is. So we have three things we want to cover today. First is inflation. And I'm going to tell you that the wave of inflation that we seem to be getting through is may very well be through, but there's another wave right behind it that we need to worry about. To talk about how the Federal Reserve is caught in a box, and it's going to be interesting to see how they get out, but it could be ugly. And then finally, what to think about the stock market going forward. And right now, the common belief is the stock market is really good for 2024, and I think you're being gaslighted. So
So
on the
Ron,
next, yeah,
let
sure,
me ask you this. So why are they saying that everything is going to be fine? Is this deliberate? Are they trying to misrepresent what's
yeah, I
going
think
on?
I think so. One of the shows we did, Kath, was called gaslighting. So it
Yeah.
was on this it was on this topic, and the people who are writing these articles want to keep your money. They don't want you moving to
Oh,
other
so
assets.
that's the real issue. That's what it
Absolutely,
is.
yeah,
Okay, so I
yeah,
wasn't
just
getting it, because it's like, what's going on with the economy right now and everything that's happening in the United States? It seems as though it's all hunky dory, but yet when I go to the store,
of course.
it's not hunky dory.
No, it's not. And no, again, I'm not a perennial pessimist, but I am screaming at baby boomers. If you're in the stock market, if you're 60-40, like most of your consultants recommend, please consider moving off to the side, at least for a while, maybe for 5 years, just because you're going to be in the risk zone. By the way, the risk zone is well documented by retirement specialists. And the idea there is, if you lose money when you're 20, that hurts a little bit. But when you lose money when you're 65 or 70, two things happen. One is
Ouch.
you might not live long enough to recover it. But second, and this is everybody's concern in retirement, this might make you run out of money. So it's a very critical time to protect the savings that you have. So on the next slide, Kath, I'm going to go through this fairly quick because when I rehearsed it, it took more than an hour, and I don't want that to happen here. So we've had one wave of inflation, and I think we're waiting for the next shoe to drop. And I'll show you in the next slide what we have. The version of inflation that we've had so far for the last 3 years is called demand pull inflation. And it was caused by the fact that the cargo ships were not getting unloaded. So the supply went down. We had reduced supply because those boxes weren't getting unloaded. And that causes inflation because when there's lower supply, people can charge more for the product, and we were paying more. And we're still seeing that. And the newest version of that is in the upper right corner here. So in the Middle East, well, you've all seen the news. We're maybe starting a war, our own war, in addition to the Israeli-Hamas war, with the Suez Canal and the Red Sea. When those cargo ships reroute, it adds 4 weeks to the transportation, which is slowing down the supply. So that's going to enter into the equation. And then secondly, it actually doubles the cost of shipping. So I just read this morning, literally this morning, that the cost per box is around $2,000. That's going to $4,000 for people who need to reroute their ships. So
Wow.
that cost is going to come in, but that's not the inflation I'm worried about. The inflation I'm worried about is on the next slide, Kath.
Yeah, it is very scary.
We see the current inflation in our when you go grocery shopping, but the one that's been building and building and building over the last 16 years is what's called cost push inflation. So demand pull is what happens when the supply is down. Cost push is what happens when the government prints too much money. And that has been going on for a while. And by the way, when I sent out the invitation to this show, and I said that the economy is in the toilet, and a reporter responded saying it's not in the toilet. No, our gross domestic product is growing nicely. The economy is growing nicely.
Oh, wow. Are you serious?
Yeah, it is. The economy is growing nicely. That's really true.
Excuse
So
me.
I'm gonna change this a little bit. I'm
Okay.
gonna say the economy is in the toilet, but it hasn't been flushed yet.
Oh, okay. So it's still full
S-
of poop.
It's still the poop is building,
Yeah.
but I don't think we're going to feel it until it gets flushed. And that that story has been going on for the last 16 years. We've been printing money and printing money, and eventually that's going to cause inflation. So the thing we're going to do, we're going to look at two things in this presentation. We're going to look at the money supply, which is the way to see if we've got too much money. If there's not too much money, there's no inflation. And then we're going to look at what the Federal Reserve has been doing, because that is really an interesting story. So those are the two things we're going to do in today's presentation. So on the next slide, Kath, many on this call, the millennials were only 19 years old when 2008 happened. So they don't even remember what this was like, but it was scary. The gears of the economy were locked. It was all caused by incenting people to take mortgage loans. By the way, some mortgages were being let out with just 2% down, which is amazing. And those are being repackaged in various vehicles. And finally, the shit hit the fan. But the answer to that dilemma in 2008 was so counterintuitive that Fred Thompson published a really cute video back in 2009. But the cowboy wisdom says, when you find yourself in a hole, stop digging. And Fred goes, we're in the hole, and we're going to solve the problem by digging deeper.
Oh, wow.
Now we're spending like crazy. We're going to solve this problem by spending more. And son of a gun,
It
we
worked.
avoided the recession. Inflation was in control, and all the stuff that you would think would get worse by doing what we did not. So that started people thinking. So what that move was based on a theory called modern monetary theory. And that theory basically says if you own the printing press, you should print all the money you need to solve your problems until it causes inflation. So the idea is to poke the inflation bear. And then if you do poke it, now this is the key thing about where I think we are now. We poke the bear. But in order to undo that buildup of money, you need to get it out of the economy. So how do you do that? Let me ask you, do you think Congress is going to do this? You increase taxes. So here we are. We poke
Yep.
the bear. The answer to that problem is not to raise interest rates and everything else that the Fed is doing. By the way, the Fed didn't need to raise interest rates. That
Oh,
demand
they
pull
didn't?
inflation, no, the demand pull inflation went away when the dock loaders started unloading the containers.
Well, that makes sense.
Yeah, so the supply went back to what it should be, and no inflation, no surprises, subdued.
Yeah.
But the Fed's raising the interest rates had very little to do with that. It was, in my opinion, mostly for show. But it did do some good things, and I'm going to talk about that as well. But on the next slide, I want to show you the money supply. This is really the key thing, and it's enlightening. So the idea about cost push inflation is it happens when there's too much money printed. And if you look at the trend line here, it looks like what it should be. There's no blip in there until COVID happens. So the Treasury has been printing money to support the economic activity, and it's been growing fairly nicely until COVID. And then I show the trend line here. So before COVID, the money supply was around 15.5 trillion. If it had continued on that trajectory, today it would be around 17.5 trillion. But it's not. It's $21 trillion. So it's $3.5 trillion more than what we really need to support economic activity. So that's a lot of money. But there's a second thing here that's sort of a nuance. I'm just going to throw it out there, and I really can't get into detail about it. But That money is in bank reserves, and the banks can lend against their reserves using basically they need 10% reserves, so that means they can actually lend $35 trillion. They have 3.5 trillion reserves. They can lend 35 trillion. So that's a lot of money. And what happened there was the printing that was going on did not get into circulation. It sat in the bank vaults. So this is more nuanced than okay. I'm going to say it. In order for inflation to peak up when there is money printing, there needs to be what's called velocity, and that means that that extra money needs to be circulated. People need to start to hold it and use it and buy stuff, but that wasn't happening. So the trick for modern monetary theory, working at least in the United States, was that velocity didn't happen, so there was very little inflation, very stable. When we started to do the helicopter money, I hope you all got your checks. That put money into the economy. It was no longer in the bank vaults. It was in your wallet. So that's really what happened to the money supply. So on the next slide, Kath, I want to talk about what that spending has done in terms of looking at what we owe. And what you want to do is look at what you owe as a percentage of gross domestic product, because the United States economy is the biggest in the world. It might have been outstripped now by China, depending on how you calculate the size of the economy. But the U.S. our debt is at around 123% of our gross domestic product, which is really high, but it's not nearly as high as Japan. So Japan has sort of been the poster child and basically been the thing everyone points to and says, no, if Japan can do it, we certainly can. We're a much stronger economy. But Japan uses something that would be harder to do here. I don't think we could do it. And the word that's been given to it is called financial repression. And what that seriously amounts to is, for some reason, the Japanese central bank can tell investors, I'm going to go to extreme here, that if they want to own Japanese bonds, you're going to get a negative interest rate or a zero interest rate. And they'll buy them. They'll actually buy those bonds at that
Wow.
ridiculous interest rate. I think if we try that in the US, we would move money outside of our borders. I mean, right now we can go to China and get very high quality bonds, for a reasonable interest rate. So we have alternatives here, and it would appear for some reason the Japanese only want to hold Japanese bonds. So our national debt has continued to go up. People have been talking about this for a long, long time. The world's in deep trouble. So the explanations for why it's continuing to get worse is that the world's in trouble, and we are the cleanest dirty shirt in the laundry basket, which
Yeah,
means
right.
we're a strong economy.
Yeah.
But most importantly, the U.S. dollar is a world trade currency. So if you want to buy goods and stuff around the world, you need to hold dollars. So that's really buoying up the value of the dollar. So no, that's sort of good news. But now this is really fun, Kath. We did a show on this uh, 3 years ago. It's on the next slide.
Oh, okay. I just wanted to ask a question now.
Sure.
With us looking at where this is going, I hope that everyone is noticing that he's building up to here's what's happening and here's what could happen to you.
Exactly.
It's not some other nation, it's not someplace else, it's not what's happening somebody where else where you say, "Oh, don't worry about it. It's not going to happen here." It's happening here. So that's where he's going with this, and that's the part that I've noticed about all the shows that have been done. It's about us. Okay,
Absolutely. And
go
and
ahead.
in particular, us baby boomers.
Right.
Yeah. I mean, it's very worrisome.
Oh, and just a second. Hi, Kinga. How are you? Hi, hon. Thanks for being on.
Yeah.
Okay, go ahead.
Thank you. So 2 years ago, season 2, episode 9, we had Professor Lawrence Kotlikoff as our guest.
He was
And
just on 60 Minutes.
Yeah, I know. He was down there with Terry Savage.
Terry
Exactly.
Savage. Yeah,
Yeah.
right.
And he's been warning everybody for a long time that this $34 trillion that we're worried about doesn't even come near what the actual liability is. And he calls it the off balance sheet liability. Now, the figures I'm showing here are from 2 years ago. It's gotten worse, but these are bad enough. So 2 years ago, the debt was $27 trillion. Now it's 34 trillion.
Jesus.
Uh, and I'm sure Social Security and Medicare have gone up proportionately as well. But so the idea is that Medicare, and this is well in the press, Medicare will go bankrupt in 2026. Now, when people hear that word bankrupt, they go, but don't we own the printing press? We do. So we're going to print some money. Social Security is going to go bankrupt in 2033. So that's a little further down the road. But there's no discussion about it. In fact, there's probably more discussion about, opening up, um, insurance coverage for everybody. So instead of the 34 trillion, it's actually more like 103 trillion. And it's always sort of fun to put that on a per person basis. So on the next slide, and this brings it home about what we really owe. If we look at the official debt, which is now really more like 34, we each owe 140,000. Now I know, Kathy, you sent yours in, so you're good. Um, but if you wanted to pay for all the debt, you'd be putting in $500,000, more than $500,000, which is insane.
Wow.
So I have a summary slide next, which this is for simplification. Wants to nope, skip the slide, Kath.
Oh, I did?
Oh, okay, it got dropped. Let me just say just the obvious thing. So in order to solve this problem, we got two things we can do, and it doesn't look like we're doing either one of them. One is we can increase taxes, and I talked about that before. The other is we can curtail spending. That doesn't look like that's happening. In fact, if anything, we're going more into debt. So we're not doing that. Now let's go to the next slide.
Okay.
So this is from the world debt clock, the U.S. debt clock. And this is really a fun thing. I have a couple of things going on here. It's a busy slide, but it's got a lot of information on it. So first of all, the word deficit is used a lot, and certainly Biden has used it to say he's reduced the deficit. And people hear that as he's reduced the debt. And those are two very different concepts. So the deficit is what we spend each year beyond what we take in. So in 2023, we spent $6 trillion, 6.2 trillion, and our tax revenues are 4.4. So we spent $1.8 trillion that we didn't have. That was the deficit.
Oh my gosh. Wow.
$1.8 trillion. And that's building. If you go to the debt clock, you can see the clock spinning. It's just going like crazy. So when I did my download here, the debt was at 34 trillion. Donald Trump's interview yesterday, he said it's 36. So it's gone up $2 trillion in the last few days. Now, the key thing about what that means and what's where system is likely to break is if we look at the interest on the debt, so interest on $34 trillion, it is 14% of our spending, which is actually $870 billion.
Oh my God.
Now, that only works because the Federal Reserve, we're going to talk about the Federal Reserve next, has manipulated interest rates to be low at 2%. So at 2%, we're spending $870 billion. When interest rates move up, say to 6%, just for example, that spending would more than double. It would move to 33%. That is what will break the bank. So the word that's used for that, when we do deficit spending like this, and we're doing that to pay for our debt, the word that economists use is called monetizing the debt. So when interest rates go up, we're going to be spending a lot more for the interest expense. We're going to increase the deficit to pay for that. And that's what's called monetizing. So, by the way, in terms of gaslighting, I could not make this up. So, the articles are saying that interest rates are resting, they will come down. And
Resting.
yes, so the Fed has said they're not going to tinker with their interest rates. And the stock market went up last year because people believe that the Fed's going to decrease interest rates because now the inflation problem is solved. This is a very complex thing. And when I get to the Fed, I'm going to talk more about why this probably not going to happen. So on the next slide, I want to summarize where this is heading. So if the Federal Reserve can keep interest rates at 2, we're going to continue to spend 14% of what we spend, and we'll be have a deficit of 1.7. If we move to 6%, that goes to 33% of spending, and we have a deficit spending of $3 trillion a year. This is the pattern that Argentina and Venezuela found themselves in. By the way, they're very resource-rich countries, and to find a resource-rich country in the problems that they are in means that they had to really mess up big time. So
Oh my gosh.
we're following their path. But so my wife is watching this, I'm sure, and she says, "No, you're too much of a pessimist. You need to be more optimistic." And again, I think you're right, Kathy. I'm warning people. I hope I'm wrong, but
Kathy, you mean Barbara?
well, yeah. Well, no,
You said my wife is what? Oh,
you reminded me just a minute ago that this is not forecasting gloom and gloom. It's
oh,
warning baby
yeah.
boomers that this is out there and they need to be aware of it. By the way, the next slide is the one I thought we missed, so that we'll cover that
Okay.
now.
Okay.
I looked down. So just in very simple terms, the problems are easy to solve. Either raise taxes or reduce spending or do both. It can't be simpler.
Yeah.
But since we're not doing that, Moody's actually downgraded the government bonds. Believe it, government bonds were downgraded 2 years ago from AAA to A plus. Fitch just downgraded it earlier this year, and the only other rating agency that has not yet downgraded our government bonds is S&P. So the rating agencies have already said the economy's in trouble. So just be aware of that. Now, I want to switch gears. We looked at the money supply. The other thing we want to look at is what the Federal Reserve is doing. So on the next slide, Kath. Now, this is really, if you write down anything about this presentation, be aware that the Federal Reserve is the arsonist that has turned firefighter. So what I mean by that
Wow.
is the Federal
Okay.
Reserve was complicit in causing inflation. Without the Federal Reserve, we couldn't print money. Isn't that
Okay.
laughable?
Yeah.
So in order to print money, the Federal Reserve had to do what it's doing. I'm going to tell you that on the next slide. But now it's this officially sort of been, yeah, okay, the next slide's fine. We'll stay there. So,
Okay. All right. Oh,
no,
you
that's
said
good. No, that's good. Yeah, next
okay.
slide's good. So this is a little picture that we've used several times in our shows, Kath. But so we don't print money by running the printing press. The way we print it is the Treasury issues bonds, and under normal situations, there are plenty of buyers for those bonds. But these are not normal situations. The rest of the world is in trouble. So, no, typically the Japanese would buy our bonds, the Chinese would buy our bonds. They're not doing that anymore. So and by the way, before I forget, the focus of what the Federal Reserve has been doing has been on short-term rates. So that's basically the interest rate on 3-month, 6-month, 9-month Treasury bills. The Federal Reserve is very much involved in controlling interest rates for longer-term bonds, 5-year, 10-year bonds. So there's a whole what's called term structure of interest rates going from short-term to long-term. The Federal Reserve can set the interest rate for short-term bonds. It cannot set the interest rates for long-term bonds. What it does instead is it manipulates the interest on long-term bonds by buying them up to keep those interest rates low. Now, what that means is they pay more than what they should to buy those bonds. So if interest rates should be at 6, they're paying too much, and by doing that, causing the interest rates to go down to 2. So I hope you get the mechanics here.
It's like buying Peter to pay Paul.
Well, that's what we're doing here. And by the way, the internet, this picture on the right says when the Fed buys bonds, it should increase the money supply. And the mechanics for that is when it buys the bonds, it increases the reserves, so the banks can loan more, and that puts more money into the economy. But when we look at the money supply, we don't see that. So what I said earlier is that money just sat in the bank accounts, in the reserve accounts. It didn't get out into the economy.
Huh.
But now with COVID, that's really changed the picture big time. And this next picture is shocking. And if you haven't looked here, you need to look. So this is the assets of the Federal Reserves. Normally, the Federal Reserve would hold about $1 trillion, and that's true for as long as the Federal Reserve has been in business. So $1 trillion is basically all it needed to make the economy run. Then when we solved our 2008 problem, the Treasury started issuing money, the Federal Reserve started buying it, and all that money, it was the bonds it was buying, went into the reserve account. And it actually printed about 3 trillion of the printing went into the assets of the Federal Reserve. So instead of running at $1 trillion, it was running at 4. And that was problematic. In 2009, Warren Buffett was interviewed, and he was asked what he thinks about this quantitative easing thing. And he said, it's an experiment of magnitude that's never been done before. And I don't know what's going to happen, but it's likely to be huge.
Boy.
And he added in that when the Fed, I'm going to use the word needs, it's probably not Warren Buffett's words, but someday the Fed's going to need to unravel their balance sheet. And that could cause havoc. He says, I don't know how they're going to do it. No one knows what the repercussions are going to be, but it's as scary as hell. Now, that's Warren Buffett.
Yeah.
3 years ago, when the Fed started quantitative easing, basically to raise interest rates, Jeremy Powell said in an interview that we're going to do quantitative easing, but the repercussions of unwinding the balance sheets could be problematic. So he knows it. The Federal Reserve knows it. I don't think the investing public, certainly baby boomers, don't know this. So $4 trillion is problematic. We printed $5 trillion for COVID. Some of that money went on helicopter money. We got our checks. Much of it went to free vaccines and vaccine development and everything else. It was $5 trillion. That is on the Fed's balance sheet. It's huge. So that grew the balance sheet of the Fed to $9 trillion, which is a lot of money. Then when quantitative tightening started, the Federal Reserve could have sold those bonds, but they're being very careful about how they unwind the balance sheet. So if they dump those bonds, it would be it would be awful. So instead of dumping them, they're just letting maturing issues mature without buying new bonds. So their intent is to do that slowly. So what you see is the decrease from 8 trillion down to 9 trillion is the quantitative tightening. So that's what the Fed balance sheet looks like. Now, this has caused a serious problem for the Fed. This is part of the thing about gaslighting. This isn't being discussed much, but it's out there. So the next slide, Kath.
Let me ask you. So,
Sure.
so that's one of the reasons they're the firefighter now.
They went from arsonist to firefighter. Exactly.
Because, yeah, of course.
Isn't that insane?
Yeah.
Now, What that's caused is for the Fed to go bankrupt by almost any measure, and that's a scary thought.
Oh, but what?
Yep. So they're there, holding out the
Whoa.
umbrella. I'm going to protect you from inflation. You just need to cross this bridge, which is got not very good support. So this is
Look
a
at this.
scary
Look at
part of
this,
what
folks. This is scary.
it's very scary.
Whoa.
So
It's like going to the slaughter.
it's I mean, people are getting across the bridge. We got across the bridge last year. So who knows what 2024 is going to bring? But again, I'm saying these very optimistic forecasts for 2024 need to be questioned.
Mhm.
So here's what the Fed's operating environment looks like on the next slide. And this is really the scary part. So the Fed's assets are the bonds that it's been buying, the long-term bonds. And they have succeeded in keeping the interest rates down. So the interest on those bonds is 2% because they paid a shitload for them. So the interest they're earning on that $8 trillion now is $156 billion in interest. That's what they earn. The interest they're paying on their liabilities, which is basically bank deposits, is $400 billion. So they're earning 156 and paying 400. So the Federal Reserve operating budget is $244 billion of loss every year. Now, you're going to love this. Where do they get the 244 billion from? Where's that coming from?
Right.
I didn't know until I researched it.
Really? Where?
So it comes from a place mark on the asset side that's called deferred assets. So that accounting, 244 billion, goes into deferred assets, and that keeps the balance sheet. It's not coming from anywhere. It's just in a bookkeeping entry. And the idea of the deferred asset is, yeah, we're losing money now, but we're going to make that back, and we'll put it back. And so every year we make some money, that deferred asset will go down. So the question is, how soon and when will that deferred asset go down? So that's the real problem for the Fed. And the next slide is one that it's gotten a lot of notice, and I think this really, so it's a very complicated picture. But let me walk you through the cycle that the Fed is in. I'm going to start in the upper right. So in order for us to be able to afford interest expense on our 34 trillion in debt, the Federal Reserve needed to get interest rates down to close to zero interest rate policy. And we weren't the only ones doing it. Governments, central banks around the world were doing that. Japan got their interest rates below zero. So that all actually happened, and we all lived through that. But once we start to unravel that, like we needed to do, by the way, again, the Fed did not need to raise interest rates to fight inflation, not this version of inflation. But I think it's a good step towards the next wave of inflation. So they started to end the zero interest rate policy. Interest rates went up. But if it continues to go up to say, so in a 3% inflationary environment, the normal interest rate is 3% plus inflation, so that would be 6%. So if the Fed's not manipulating bond prices anymore, the tendency will be for interest rates to go up, bond prices to go down, and the 5%. So if the bond prices continue to do that, there'll be about a 30% loss in bond prices. You'll lose 30% in your bond portfolio. Then moving from there to the left to the debt service increases. We went through this, but if we go to higher levels of interest, the expense on the debt goes up. We're back in the pickle that started the ZIRP. Stock prices will fall. Now, they'll fall for two reasons. One is the borrowing costs for corporations will go up, but also when analysts evaluate what the firm is worth, they discount future earnings at an interest rate. If that interest rate goes up, the value of the firm goes down. So what happened in 2013, when the Fed actually sort of just began to tighten a little bit, stock prices went down. They took flack. They got pressure. and the Fed is not supposed to bow to pressure, but they did. So they reversed and stopped undoing their balance sheet, and that was called the taper tantrum of 2013. So that's the cycle we're in, and it's very complicated. And like Warren Buffett and Jerome Powell said, it's no one knows where that's going to end up. So the next thing we want to talk about is the possibility of a stock market crash, and that's
Let
on
me
the next
say
slide.
let me say hello to Calvin. Calvin, how are you, my dear friend? Thank you for watching. He says this is excellent.
Thanks, Calvin.
Okay.
I buy your jeans.
Yeah, right.
So this is really critical, and the gaslighters are saying 15, 20% returns in 2024 on the U.S. stock market, but they're all basing that on a belief that the Fed will pivot. They'll go back to manipulating interest rates again. They'll lower the interest rates, and everything will be all good. So what happened in the last 2 years is I think really intriguing. So our last episode, Kath, in 2022, we had 4 reasons that we were concerned about the economy and the stock market. And sure enough, 2022, the stock market was down 20%.
Huh.
So we weren't forecasting, we were warning.
Yeah, right.
But
Yeah.
last year, the stock market was up 25%. So we are right now at a level in the stock market that we said was way too high at the beginning of 2022. But here we are again.
Mhm.
So by any estimate, and anybody who comments about the expensiveness of the stock market, there's general agreement. It's very, very expensive. But I'll tell you, the millennials are in there blowing it up because they've never seen a stock market go down other than their little tease in 2022.
Exactly, exactly.
And here's some, sort of an interesting observation that I just actually just saw yesterday. So there's this professor, Jeremy Siegel, who's written books, but this most popular book is called Stocks for the Long Run. And he's a perennial optimist. He always sees the stock market going up. And the headline says this, and it's paradoxical. It is Siegel says stocks will be up 10% in 2024 unless the Fed lowers the interest rate. Now think about that. Investors are counting on interest rates to go down for the stock market to go up.
Mhm.
So here's what Jeremy Siegel says. He says, if interest rates go down, that means that the Fed is fighting a recession. They should not lower interest rates unless there's a recession. They should just leave it alone. So the common belief is they're going to lower it because now they got inflation under control, but there's no reason to lower it.
Right.
And certainly they don't want to stimulate the stock market anymore because it's already so stimulated. So Siegel says the only reason the Fed would lower interest rates is not because inflation is over, because it probably isn't. But second to that, they would only do it if there's a recession. If there's a recession, that's never good for stocks. So you get the catch 22 there. The
Mhm.
headline definitely gets your attention. So we're I think, well, we might get a recession, then Fed will lower interest rates, but then we're going to get the stock market crash either way. So I didn't know
You think
either.
so? We will?
I think it's a real possibility. And one of the things that I've said several times, but I had a friend, a professor, Dr. Robert Haugen, Haugen, and he wrote several books, but one of his books was about what he stated was the fact that the stock market crash of 1929 was not a leading indicator of the Great Depression. It was the cause of the Great Depression.
Oh, really?
And the book makes a lot of sense. I think it's called, oh man, The
Oh,
Beast on Wall
man?
Street.
It's called Oh,
Yeah,
Man?
no, it's called The Beast on Wall Street. So basically, the beast was the stock market making the economy crater rather than the economy making the stock market crater. So yeah, I think there's a likely crash, and it's actually on the next slide, Kath. It's really really
Okay.
interesting. So we've shown slides like this over and over again, but so there's a lot of measures of the expensiveness of the stock market. The Buffett indicators is in there. There's price earnings ratio. There's book values and everything else. But so the gaslighters say that the markets keep going higher. What this graph is showing it's the ratio of the stock market value to the value of the gross domestic product. And the last time it was well above the trend line was in the stock market crash of 2000. Then went down and it finally recovered. It went down in 2008, which you see the blip down there. And then it's been building up. It's way above norm. 175% of the market, the value of the market is 175% of GDP. You see that little blip where it went down last year? That's the loss of 2022. And then came right back up. And the only reason that graph didn't come back up to where it was before is we've had good growth in the economy. So GDP has come up. And even though the level of the market has gone back to where it was at the beginning of 2022, that Buffett measure is not going up nearly as much, but it's still very, very expensive. So that's one thing to keep in mind is that we're paying a lot to be in stocks. And normally when that happens, the stock market corrects and gets us back towards that trend line. And by the way, these prices are being driven by two things. The level of earnings, which, by the way, the earnings on U.S. stocks have been okay. But they haven't been enough to support this. The other thing that lifts the value of the stock market is what's called the price earnings ratio. And that is the price that investors are willing to pay for $1 of earnings. That's the other measure of the expensiveness of the economy, and it's very, very high. So we are paying much more today for stocks than we were on average. So the stock market is very, very rich. Now the other thing is on the next slide, Kath. Just want to see. Oh, we're going to make our hour time limit, which I'd really like to do. Oh, by the
Okay.
way, hang in there with us, folks, because I'm going to tell you what you need to do if you want to move to safety.
Yeah, exactly right. Yeah.
So
The good part always comes at the end.
yeah, if I did it at first, we lose all our viewers.
Yeah, right.
So then a normal economic cycle has 38 months of growth, 18 months of contraction. So the full cycle is 56 months. We have not had a correction for 12 years. I don't count 2022 as a correction. So just in terms of timeline, it's way overdue. Then one more warning for you to be aware of that you maybe never saw is on the next slide. And this is something by way of gaslighting. I saw two articles on Monday, January 8th, that I've never saw before. And I might never see them again. But basically it's saying the banks are in deep doo-doo. So those two failures we had last year, that's just the tip of the iceberg. And what's going on there is two things. One is this thing called disintermediation. It's a long word. But what it means is if you've got your money in a bank account, a savings account at a bank, you're earning like 0.6%, less than 1%. And you look at that and you go, well, I thought interest rates were higher. Well, they are. All
But
you need
not
to
for
do is
savings.
not for savings accounts. All you need to do is move your money into a money market account. You'll get close to 5%, make a hell of a lot more money. So banks, the headlines go more like investors are moving to cash. Well, they're moving to money market accounts. So you're moving out of their bank and into money market accounts. The other thing that's going on here that's the real story is office buildings are vacant. So that means that the people who own those office buildings are not getting revenue, which means that
Exactly.
their loans are underwater. So the banks who have lent money for financial real estate are facing a serious crisis. So watch for that next shoe to fall. So we're being warned this is a banking crisis on the horizon, which is part of what happened in 2008. We had problems with bad loans, bad real estate loans, basically, but for U.S. mortgages rather than for um, corporate buildings. So just a summary on the next page, I'm going to get to the punchline, Kath.
So, Ron, wait a second.
Sure.
Uh, Are you recommending money market accounts?
Yeah, why not?
Okay. Yeah,
Why would you
instead of
keep your money? It's so you might say,
I have.
yeah, yeah. It's so one of the responses to that is, well, the money in the bank is FDIC insured. Well, the money in the money market account is insured by a different entity. It's SPIC insured, and I think it's insured up
Okay.
to $500,000. So you
Okay.
and if you put it in a Fidelity or T Rowe or Vanguard, you can be pretty sure that you won't lose your money. So the only way you lose your money in the money market account is if the brokerage house goes out of business. So you wouldn't want to put it in the next door money market account.
Okay, so if I put it into a money market account, do I have any, stipulations of how I can take it out?
No, anytime you want.
Anytime I
That's
want.
yeah.
Okay.
That's unlike a CD. If you put in a CD, you're locked in. You can't take it out without penalty until the CD matures. So yeah,
Okay.
money market
Well, then
accounts
why
will work.
haven't I done that? Why
I
haven't
don't
I
know.
done that?
Well, most people. I mean, I'll bet you a lot of people on the call haven't. I'll bet you
Yeah,
they got a shitload
exactly.
of money in their savings account in the bank. It's
Well, because that's old school and
and it's
yeah,
convenient. It's convenient to have it there, but
right, yeah, and you can
you can always
transfer
move.
back and
Yeah,
forth.
you can write checks against your money market account. You can.
No, well, then that makes
Yeah,
sense.
it does.
Okay.
So that's happening. So I love this picture because it basically says we're out on a limb,
Yeah.
and this whole thing has been about preparation. Maybe the toilet will get flushed. I'm not sure how long that would take, but when it
Or
does,
overflow.
yeah, we're going to be, I think, in a deep pit. We'll see hyperinflation. We're going to see a market crash, and so I'm doom and gloom. But the thing for the baby boomers is that's on the last page, and I want to make sure I get to that, Kat. So let's do that next page.
Okay.
So I have an article that's on Seeking Alpha. So when stocks and bonds, so stocks won't do if there's going to be a market crash. Bonds won't do because interest rates are going up. So interest rates go up. This is something that many don't understand. When interest rates go up, bond prices go down. So you'll lose money on your bond investing. So what I'm recommending here on the left-hand side is if you want to construct a portfolio, one of the things you might want to look to is the Talmud. Now, the Talmud is not the Hebrew Bible. It's the guidance from the Bible. The Bible is called the Torah. So the Talmudic advice is to put a third in reserve, which is basically safe money, put a third into real estate, which is pretty obvious, including your house, and a third into business. So in these diagrams, the third into safe money would be guarding against inflation. So Treasury inflation protective securities tips guard you against inflation. So inflation goes up, the value of the bond goes up. So that's one thing to keep in mind. You can also do floating rate bonds, but they're normally lower quality. Then in terms of your risky assets, the half of that, which would be a third of the total portfolio, would go into real estate. And there, for obvious reasons, you say don't invest in office buildings right now. Probably not be a good thing to do. But the third that would normally go into business, I think could go into things that will appreciate in inflation, commodities, gold, even Bitcoin, precious metals. Those are examples. I'm not recommending those particular proportions. So you can move your assets into something that might not go up when the stock market goes up or bonds go up, if they do. But you should be protected if this terrible thing happens. The other choice is to hedge, and this is more complicated. But for the more sophisticated people on the call, you can do hedging on your own, or you could use hedge funds. But if you hedge on your own, you could sell short, and that's something to do. You could you could buy. So people think options are risky, but if you buy a put option, that's insurance. You're buying insurance. You could sell insurance by selling call options. I'm sorry, you wouldn't sell. That wouldn't be selling insurance. It would be another way to place the bet. There are exchange traded funds that bet against the stock market, bet against the bond market. There's actually these channeled investments. They're called innovator ETFs that limit your upside, but they also limit your downside. And then, I mean, these are all examples. These are just things you could do on your own. If you decide, if you're what's called a qualified investor, which means you're wealthy, you could use hedge funds, but there you need to pick the kind of hedge funds you use carefully, because some of those hedge funds will probably lose money. The next they're betting on the upside rather than the downside. So you want to single out hedge funds that do protect you. So that's the show. And the next slide, Kat, just want to make sure people
Did
know
you
how
see
to reach
that,
us.
Pat? Thanks, Pat.
I don't care. I saw it. Thanks, Pat. Thanks for watching.
My brother has such a. By the way, we're
It's
brother and sister for
oh
those of
yeah,
you
that's
that
right. We
don't
should tell
know.
people that.
Yeah, right.
So here's how I can be reached, how Kathy can be reached. Kathy is doing this wonderful thing called the Golden Life Community, and it's for baby boomers. It's basically virtual and physical communities for single older ladies. So we don't call it Golden Girls because somebody else has got that. But it's a golden community, and it's a place for you to live the rest of your life with people you like, uh, if not physically, at least online. So a way for you to
Right,
network. I'm
right.
involved in target date funds, which I didn't talk about at all here, but that's what I'm doing to help the world. So,
Okay.
Kath, do we have any questions?
No, we don't have any questions. We just had
We made it in the 1 hour time frame.
we made it in the 56 minutes and 42 seconds.
All
Yeah.
right. Yeah. I hope we kept our listeners interested.
So I want to say to everyone, thank you so very much for coming back and watching the show. We intend on doing more of these. Again, it depends on health reasons and et cetera, but we're planning on it. So stay tuned. We look forward to having you around. Any last comments, Ron?
I just want to say thanks, Kath. I know you rallied. I know you're fighting your
My health
problems.
issues, yeah.
Yeah, your health issues, but you did a great job. Thanks for doing
Oh,
this.
well, thanks so
So
much.
I could not do this without Kathy. So I don't know how to make the slides go in and out and do
Yeah,
all the cool things she can do. Plus, she's a lot of fun.
yeah, I
So
am.
you
I'm a
are,
lot of fun.
yes,
Yeah.
yeah.
Okay, everyone. Thank you so much.
Thanks,
Bye.
Kath. Bye now.
Bye.